welcome. You're watching Money 9. I'm Sakshi Batra, and on this show, we are going to be discussing all about markets. Well, the stock markets are at record levels. So, where do they go from here on? And how should you, as investors, really approach this market, which is at steep valuations but is not stopping short from claiming more record highs from here on? Joining in is a very special guest with me. I have with me Mr. Avinash Gorakshakar from Profit Mart Securities, who's joining in on this edition of Market Masterclass. Good afternoon, Mr. Gorakshakar, and thank you very much for taking out time for us. It's a pleasure to have you with us. Let me just start by congratulating you for being a part of the stock market and seeing the markets climb all-time highs, both on the Sensex and the Nifty as well. It's been a spectacular rally that we have seen, and you've been a major part of it. So many decades you've spent in the markets. So congratulations on that, and help us understand at this point in time, where do you see the markets going forward from here?
I think you should congratulate all the retail investors, because this is an event to celebrate for all of them. My sense is, the markets, Sakshi, are not going to stop here because, one indication which we are clearly seeing is what is the kind of frenzy we are seeing in the IPO market. The IPO market is a, kind of an offshoot of the secondary market. And I think the kind of appetite we are getting, for most of the IPOs which are getting listed, I think there's a tremendous appetite. So I think the good part is that retail money, HNI money, and the domestic financial institution money is coming in, despite the fact that FI flows have been negative. Secondly, I think on the macro side, Sakshi, good news is that the GST numbers are getting better, the vaccination run rate is getting better, and I think despite some reports about the new Delta variant coming in, I think the markets are confident that this would not be such a bad kind of phase, unlike the first and the second COVID wave. So I think we would like to keep our fingers crossed, because predicting the index is always going to be a tricky part. But yes, I think historically, whenever a new level is crossed, I think the market definitely looks at recording further fresh highs until and unless some major kind of event happens, which I don't think is going to happen, at least in the near term. So there's no need to panic. But yes, regular profit booking and regular price corrections could happen. So investors need to be very careful now. I think rather than betting on everything and anything, I think they need to be selective, and I think that would be the best strategy for them.
Okay, so the markets will clock in higher highs from here on, but it's time to be selective at this point in time and not go aggressive and buy out everything that you're seeing in the markets. We will talk about the IPO space that's buzzing as well. But first, help me understand, since you said that the markets are not looking at any major red flag at this moment, going forward from here, when the markets are poised to go from here, which is the pocket of the markets that will outperform or lead the next leg of the rally?
See, I think clearly, companies which operate in the, manufacturing space and which operate in the rural, agro kind of space, these are the companies which are going to do very well. And I would believe, the second pocket would be most of the internet and the, e-platform kind of companies, because that is one pocket where investors have realized that working from home has now become a part of life. And I think you're going to see a lot of companies like stockbroking, depository companies, asset management companies, insurance companies. So these are all pockets of opportunity. In fact, the financialization theme is going to be very important. And plus manufacturing sectors like capital goods, and obviously, within that, construction companies should do well. So I think there are pockets of opportunities, but yes, I think one has to be selective on companies and obviously look at valuations, from a time to time, basis.
Right. But are there any sectors that would be perhaps a major pain point for the markets going forward from here? Perhaps because they have run up too much? Anything that you're looking at with a caution?
See, I think in terms of pain point, my sense is, I think, sectors which are luxury sectors, where these are not affordable kind of products, that is one segment which could be possibly be a subsegment of many segments like real estate. Affordable housing is definitely picking up, but luxury segment is definitely down in the dumps. Similarly, I think if you look at, the jewelry market, I think obviously if you look at the Indian scenario, I think obviously there also, the higher end segment is definitely got impacted very badly. So clearly, wherever the necessity, adjective comes in and where products are being consumed by the masses, those are sectors which will play out much more strongly. and of course the higher end sectors will also pick up, but I think the economy needs to take off little further. Only then spending will come in and you will see these sectors doing well. So I think broadly, some of the sectors which are really now in the doldrums, like airlines, or for that reason tourism or hotels, these are sectors which are lot in the limelight because of the unlocking kind of theme. But I think for numbers to get into place, I think it's going to be at least another, say, 2 to 3 quarters. So I think these could be the pain point sectors where markets are not looking at numbers; they're just looking at some hope that normalcy would come in fast, and that's what driving these sectors.
Absolutely understood that. Also, your take on the banking space, especially the private banks. Now, we've got some signs of stress, especially on the retail book in banks of, say, HDFC, Kotak, ICICI. Can one really ignore the uptick that the banks have reported in this quarter as far as the retail book is concerned at this point?
See, I think my guess is I think the retail book has continued to grow for most of the larger retail-based banks like Kotak, or for that reason Axis Bank or an ICICI Bank or even an HDFC. The bigger problem is that April and May has seen some sort of slowdown in terms of dispersals, in terms of recoveries. So I think a lot of banks and NBFCs like Bajaj Finance have made a lot of provisions. So I think this is something which obviously a lot of people in the market were expecting. Our sense is that hopefully, after September, things should get normalized and you could see a stronger run rate in these banks and NBFCs, because typically, COVID provisions are not going to be significant from September onwards. So I think probably banking is one sector which has underperformed and which will obviously lead the rally if you want the Sensex or the Nifty to get re-rated further, because typically, Nifty, we have 35% weightage for the financial services kind of companies.
Right. And what about SBI? I mean, it reported a spectacular quarter in terms of the profits that it has, reported this time around. There seems to be a recovery which is faster than the anticipation on account of the second wave of COVID-19, as much as that street was penciling in, or the industry average as well. So what's next for SBI? We've seen it at all-time highs. Brokerage houses are very bullish. There's a wide difference in the kind of rates that they've given. Some are also predicting over 700 kind of targets. Is that too stretched at this point, or do you think it is possible for SBI?
I think one thing is very clear, Sakshi, that the SBI of today is very much different from what it was 5 years ago. SBI is a public sector bank, but it is managed like a private sector bank, and I think most of the asset quality, provisions, the bad loans have already been written off. So my sense is that SBI has done a very good set of numbers in a very challenging scenario. Although the asset quality number has marginally got elevated in the quarter 1 of FY22. I think what was encouraging was that the provisions have come down, which means the bank is confident that asset quality problems may not crop up further. And I think in terms of re-rating, the bigger issue would be, what could be the corporate loan book growth. I think in this quarter it was about 6%. So I think if it touches around 9-10%, that would be a big key re-rating trigger for SBI, and plus some sort of value unlocking, for SBI, because there are many assets which possibly could get unlocked. Markets are clearly waiting for the AMC now to get listed because they have a large AMC business within SBI. So I think, all said and done, next 12 to 15 months definitely looks positive for SBI.
Okay. One particular sector that is of late too much in news, I wanted to ask you about the telecom sector. Now, this sector is grappling with a lot of AGR issues. There's a lot of tussle between the Department of Telecom, the government incumbents. Recently, we've also seen that Mr. Kumar Mangalam Birla has stepped down as the non-executive chairman of Vodafone Idea. What does this mean, or what could this mean? Would it mean that the company would now be approaching NCLT? Would it be winding up, selling out to another investor, or thereby Vodafone PLC taking a bigger stake? How are you understanding this kind of a move for the company?
See, I think my sense is that Kumar Mangalam's move has actually rattled the markets, and I think that is the main reason why the Vodafone stock is down by almost 40% in the last 2 to 3 days. I think obviously, whenever a promoter talks this kind of language, the markets get panicky, and this is exactly what is happening. But from a realistic point of view, the government would not like this industry to be a duopoly, and that would put customers at risk, because obviously we had about 40-50 companies in the telecom space, and now if Vodafone is completely out of the picture, that gives too much dominance to the existing two players. So to that extent, my sense is that there could be a possibility that Vodafone could get some benefit from the government post their payment of the AGR dues. And I think it's a matter of months, Sakshi, where possibly some news flow could come in on the funding of Vodafone. So I'm not suggesting that one should go out and buy Vodafone, but yes, from an industry perspective, I think it's too early to say whether Vodafone will be completely out of the market. So I think it's better to wait and watch. But yes, the markets are definitely looking at the fact that in case there is a bankruptcy, then I think it's going to hurt most of the banks who have funded Vodafone, especially banks like SBI, PNB, IDFC First, where you have seen a lot of selling. So I think it's better to wait and watch. The market always thinks overly positive or overly pessimistic on any news development. So I would prefer to wait and watch, and I think things could change a little better in the next, say, 2 to 3 quarters.
And for those investors who are already sitting on some losses, who perhaps bought the stock at say 11, 12, thinking that their things would improve, they've seen their profits drastically crash, what should they do?
See, I think I'm not suggesting a buy on the stock. I am only saying that the industry is not going to see a shakeout. So, Vodafone India could survive. But as far as the stock price upside is concerned, if at all there is a survival package or a funding from a foreign institution into Vodafone, then that could be a kind of a good opportunity for investors to exit, because that could give them a kind of a big jump, at least the initial kind of jump, on the stock price, because this is something which is, the company has hit its rock bottom level. So I think probably that would be a good way to exit the stock rather than putting fresh money here, because any business which is not generating cash flow is definitely not something which will generate wealth over the longer term.
Okay, understood that as well. Before talking about the IPO space, I also wanted to take your view on one more sector, and that is the pharma space. Now, in the last 1 month, we have perhaps seen slight underperformance in this space, largely. So, would you really use the kind of dips that we are seeing to add on to any of those quality names? Because already we've seen a sharp run up in this space. Would you say the COVID bump of the pharma companies is over, and is it going to be in consolidation phase after that one-way up move that we've seen from the March lows for this sector?
I think, see, in the pharma space, you got to bet on companies, which are doing a lot of work apart from COVID vaccines. I think vaccines had a one-time impact on the stock prices, but if you look at the, the contract research space, or maybe, even the specialty space, I would suggest that there are many companies, Sakshi, which could do well over the next, say, 2 to 3 years. In fact, there are many companies which are into contract research. So, companies like Syngene, or for that reason, Divi's Laboratories, or typically even a Sun Pharma, which is now shown remarkably very strong numbers. So, I think one has to be selective here. I would be more comfortable on the Indian companies rather than the MNC companies, which, trade at very expensive valuation. So, Indian companies offer a good, kind of price risk reward. And yes, the API companies, the API companies still continue to do well. So, many companies have entered the IPO market. There are many existing players. So I think investors can pick and choose, from the API basket also.
Okay. And just last 2 questions there. And the first one being on the IPO space, we have seen the kind of buzz that this space has already seen in H1 of 2021, about 28 companies raised about 42 odd thousand crore rupees already from the IPO space. The kind of participation the retail investors have shown, over subscriptions, tell us the frenzy is at its optimum at this point in time, and the markets are fully, and retail investors are fully invested at this point. Are you looking at any of the IPOs that are interesting you at this point in time? In your experience, are valuations a fair parameter to judge these new companies, or how are you looking at this space?
See, I think, as of now, the IPO market is clearly, a seller's market. So, typically whatever is being sold is being digested by the buyer. But I think you have to look at companies, which have got a lot of brand value, a lot of franchise value. And I think companies which can actually be in existence for the next 5 to 10 years. And in that aspect, I think, companies like Devyani International, which is the franchisee for KFC, Pizza Hut, I think despite the fact that they are loss making at the net level, they have an operating margin which is positive. They're generating pretty good operating cash flows. So I think investors need to take a longer term call and see the business quality of the IPO. Rather than looking at just the pop-up on listing. I think if they obviously keep these companies for a longer period of time, then wealth creation can happen. But I think in 90% of the cases, I think it is just the listing gain which possibly all the retail investors are looking at.
Absolutely. So I want to take your view, for the second half of 2021, what's your outlook as far as the markets are concerned? For all those investors who are entering at this point in time, looking at the fresh highs that the markets are hitting, what's the best way to approach this market? Should they go for a sip in stock? looking at, the kind of already steep valuations that we are at, and how much portion should I invest in the primary markets or the secondary markets? How should I balance the two? And which segments do you think I should have maximum exposure to?
See, I think clearly the secondary market and the primary market are clearly interconnected. So my sense is that unless you have a large kitty with you, there's no point in applying in the primary market. As you might be aware, primary markets are being funded largely by HNI money and funded by the banks and NBFCs. So I think if you're comfortable with funding, you can obviously look at the IPO route. People normally rotate the same capital. If they get allotment, they sell it. So they make a decent ROI in a very short period of time. But the secondary market, I would believe that investors need to understand that we are not going to see a panic sell-off, and quality companies are not going to be available at dirt cheap prices. So I think start building an SIP gradually over the next, say, a 5-year time frame. And I think allocate money, depending upon your budget, but make it consistent. So I think that would help you to, build a portfolio which is going to be, ready for the next 5 years. This kind of market may not continue, it may correct. But if you put your investments in a systematic SIP approach, then I think money can be made. See, I think the biggest question is whether I'm buying it at the right price. But stock markets have always surprised all of us. So good companies don't have any limits on the upside. So please remember that people always look at buying a TCS at a very cheap price, which is really impossible. So that is what people must understand. Don't try to go for a bargain for a blue chip company. I mean, you must remember that it will always trade at a significant premium, in the market.
Absolutely. So there's no upside for good companies. That's the key takeaway. You should stagger your investments and follow the systematic route. That's the best way to approach this kind of a market, which is at all-time high levels. Thank you very much, Mr. Gorakshakar, for speaking to us, sharing your wonderful insights on the market and the way investors should really approach this market. Always a pleasure having you with us on Money Line. All right, and then let's wrap up this edition for you on Market Masterclass. We keep getting you such interesting conversations with market veterans and experts who understand the markets deeply and who give you the right advice as to how should you be really putting in your money, your investments in the equity markets. With that, I wrap up this show. Many thanks for tuning in, but do stay logged on to us. You can like and subscribe to our YouTube channel. Hit that bell icon so that you can get to know whenever we put out a new video. Also, stay connected with us through all our social media platforms and visit our website money9.com for much more on markets and on personal finance. Thanks for tuning in.